Hey guys, thought I'd give you an update on what I've been buying in the last week, and what I'll probably be continuing to buy if these stay the same price, which is Shell and Taylor Wimpey. Just sort of give you an overview of why I'm buying them. Obviously, as you can see, the price is nearly down to their sort of peak drop in March. I think they went down to just about £10, and they're nearly back to that. Really can't see why. So as you can see, they're a large company, 82 billion. The dividend yield 14% is wrong. It's based on the previous year's dividend, which is not getting paid. They're currently paying 16 cents a quarter, which is about 12.5p. So that would give you about 50p or 5%, which as a cut dividend, I think is quite good. This will give them more money to invest in the renewable side of the business that they want to move to, and other ventures. They're getting into energy supply to compete with British Gas and Eon and the other big energy companies. And I expect they'll be looking to raise the dividend as they start to get back to profitability. So a PE ratio, I'll sort of go into a little bit more in the financials. Just have a look at the financials. I tend to use Hargreaves Lansdown for a lot of the sort of UK companies to get a bit more info on them. So as you can see, the last sort of 5 years, revenue has been sort of broadly increasing, which is pretty good. Profit again sort of increasing reasonably well. So earnings per share, again, sort of a fairly bad dip back in 2015 on the right, and then sort of a bit up and down, but sort of broadly up, coming to sort of a height of £2.80 or €2.82, and 197 last year. So they've taken a bit of a dip this year, but as you can see, the oil price sort of has certainly rebounded since last quarter, and hoping they should be sort of getting back to some sort of profitability. They don't just sell oil, they also do sort of plastic products and other oil-based products. And as I say, they've launched the energy supply business now. So if they're sort of anywhere near the sort of 150 to 250 range, then you're looking at sort of PE of about 5, which is pretty good. Or maybe sort of 5 to 10 if they're on the lower end of those earnings, which is fine normally. It's an undervalued stock. So they've still got a reasonable amount of cash, as you can see, and debt levels not too bad. Not been sort of, there were 82, again, long-term borrowings were 82 billion in 2016, 81 billion now. So again, not too bad. They haven't had to do a share issue or anything like some of the other companies I've been invested in. It doesn't look like they're going to. They've just been cost cutting, and so they should be fine. And cutting the dividend will, as I say, give them more money to be ploughing into other ventures, diversifying. And keep buying in, averaging my position down, and I think I'm at sort of about £11.60 now. I've been investing in my Trading 212 Invest account because I've maxed out the ISA, and yeah, we'll continue to do so. I think I'd be looking long term to probably have the shell position about £5,000. Yeah, so see how we go. The other one was Taylor Wimpey, house builder in the UK. They're sort of quite conservative, as you can see, even based on last year's dividend. I think they only paid half their dividend, so it is quite low. I think this was sort of about 5 or 6% if they'd have paid the whole dividend. But yeah, they'd sort of cut that. They're not paying it at the moment, but I would expect them to get back to it at some point, because they've got back on site and they're building houses. They've got a reasonable order book. So again, they've had a few issues in the UK with leasehold properties. Has caused them to sort of come down again a little. I was sort of buying in around £1.20. They're now down to £1.10. So I'm continuing to buy. They're one of the larger sort of house builders, 4 billion. You've also got sort of Persimmon. It's not that big a market really in the UK, so I think Taylor Wimpey they have to be building houses. We've got a shortage in the UK and high demand, so they're always going to do well really. But yeah, so they've been buying up land while it's cheap. They've increased their borrowings a little. If I have a look into financials, if they're increasing their borrowing and buying land at cheap prices, then I would think that's worth increasing the borrowing. They're not just using it to sort of pay their way out of the pandemic. They're sort of thinking long term. As you can see, the last sort of 5 years, revenue steadily increasing. Probably take a little bit of a hit this year, but for looking at next year, should be good. Profit steadily increasing, and earnings per share sort of broadly increasing. It's sort of leveled out a little at the last few years, but if it stays, even if it goes down to sort of 15p, still a pretty good price to earnings ratio. If it gets back up to 20p, then as you saw on sort of the front page, you're looking at sort of about 5 to 5.5 PE ratio. So for a company with good order book and reasonable profit and a reasonable land bank for the future to keep building, then 5 PE seems incredibly cheap. May have been sort of dropped by some income investors because they stopped paying the dividend, but I would think they'll return to it at some point. It may be cut. If they start paying out 3 or 4p, then a company with sort of rising revenue and rising profits and a dividend of, it'd be about sort of 2.5 to 3.5%, depending on what they pay, I would think is a reasonable company. It's what most of the big US companies pay, and you can see they were raising it quite a bit over the last few years with the rising profits. So I would think they would continue to be a dividend grower. As you can see, the from £1.67 pence to 6.24 pence, you're sort of nearly four times the dividend in 4 years or 3 years. So seem a strong company, reasonable amount of cash, and not that much borrowing really. As I say, I think they've taken on a little bit more borrowing this year, but it's to buy land, so it's essentially cutting out costs for future purchases. So I would say that's a good use of debt, and yeah, so reasonable price at the moment. I think again I would be probably looking to build this position up to about 5,000. Nothing probably more than that, as it's only sort of a single stock in the UK. I do want to have a sort of reasonably diversified portfolio, but I think long term probably keeping this around 5,000 and rebalancing when necessary would be a fairly prudent move. So yeah, that's what I'm sort of buying and have been buying, and as I say, will continue. So like, comment and subscribe if you want to see more, and let us know if you like these sort of slightly more individual stock analysis, and speak to you soon.